The first lecture is about risk, return, and the diversification. You can see that if you have some difficulty in understanding the course materials, you can read the textbook. To be more specific, this lecture is very much related to chapter 10 and part of chapter 11. Okay, now let's start. Okay, first, let's do a very interesting experiment, right? Let's say you have $100 and you're thinking about making some investments with this $100, and you're very lucky. You were actually placing your bets, or you were actually making your investments on January 31, 1956. So now you have four choices, right? You have, the first one is this TSX composite index. So you could put your money into this index. And the second choice is SP 500. The third choice is 30-year Canada bonds. The fourth choice is 3-month Canada T-bills. I think I have not talked about what is actually a composite index. So let's just say this index represents Canadian stock market, right? So if you invest in this composite index, you're investing in Canadian stock market. The second one, let's say it represents US stock market, right? So if you're investing in SP 500, then you're thinking about investing in US stock market. So this third one is about long-term bond, right? So if you're investing in this 30-year Canada bond, you're investing in a long-term bond, which is obvious because it has a maturity of 30 years. Now the fourth one is a 3-month Canada T-bill. So this is a short-term bond, right? So you're investing in this short-term bond. Okay. Now let's see. Oops. Oh. Oops. Okay, now let's see what kind of result you can get, right? Let's say you started investing $100 on January 31, 1956, and you invest until 2016. So I guess it's December 31 of 2016. So you would invest for 60 years. It's a very long-term investment. And you can see that now you have basically 5 curves, right? So this blue curve, right, this blue curve, it tells you how much you can get if you invest in SP 500, right? So this is SP 500. This guy, the second sort of, I don't know what's the color here, brown curve, right? So for this brown curve, it tells you how much you can get if you invest in Canadian stock market. Now this third curve, well, this one tells you how much you can get if you invest in long-term bond. Right? So this one, it tells you how much you can get if you invest in short-term bond. Okay, let me write down these names. So this is what you can get from the US market. And this is what you can get from Canadian stock market. And this is what you can get from long-term bond, right? Okay. And this is what you can get from short-term bond. Now, what is this last line? Well, this is this consumer price index. It basically gives you this idea of inflation, right? Of course, our major focus are the first 4 lines. If you look at these four lines, you can actually see some patterns here. First, you can see that you will get the highest return from this US market, and you will get some sort of similar high returns from the Canadian stock market. And then your returns from long-term bond and short-term bond are both lower, right? So basically you can see that stock market gives you higher return compared with this bond market. Now, this is just about return. If you pay attention to the shape or to the zigzags of these curves, you can see that for these first two lines, for this blue line and for this brown line, you can see that both lines are not smooth at all, right? So you can see that you have a lot of ups and downs. For example, if you look at this US stock market, then you can see that you get this peak here, right? This up here. And then you have this big drawdown here, right? You have these ups and downs. And you can also see that you have other ups, down, right? Ups and downs. So this basically means, yes, in the end, you will get more money from the stock market. But in the process of getting your return, you have to experience a lot of ups and downs, a lot of fluctuations. And then if you look at long-term bond and short-term bond, you can see that, well, if you look at short-term bond, you can see that this line is really smooth, right? So this is the line for this short-term bond. It's very smooth. But it basically means that in the process of getting your return from the short-term bond, you just experience very little fluctuation, right? Now, what is fluctuation? It's actually risk. Think about this. If you're investing in the stock market, if there are a lot of ups and downs, you will have to experience a lot of emotional stress if the market drops a lot, right? And compared with short-term bond, you get very smooth this upward return. Well, it's like you're feeling happy every day, right? So basically the lesson here, the lesson from this experiment is, if you make investment in stocks, you will get higher returns, but you will have to bear higher risk. And if you make your investment into bonds, you will have lower returns, and at the same time, you will experience lower risk. Now, if we push one step further, then you can see that this experiment basically tells you that if you want to have higher return, you will have to experience higher risk. So there is a positive relationship between return and risk. So let me summarize. What is our observation from this experiment? Well, the observation is a investment which gives you higher return generally has higher risk. So there's no free lunch in the financial market, right? It basically says, if you want higher return, then you have to experience the pain from higher risk. So why this is true, right? Well, intuitively, it basically means that if an investment has high risk, and as an investor, I don't like risk, then this investment has to give me higher return to compensate higher risk. So basically, the story here is higher return is a compensation for higher risk. That's why if you have higher risk, you will get higher return. Or if you want higher return, you have to bear higher risk. Now, the second topic is about how to measure a stock's risk and return. Basically, you can see that we have this general idea that this general idea of positive relationship between risk and return. However, it's important for us to understand how do we actually measure, right? How do we calculate risk and return? So first, we will start from probability distribution. This is more of a theoretical topic. However, if you have learned about this, if you have learned about probability from your statistics course, then this will not hard. I would say it's actually pretty easy. It's just basically mathematics, right? So when we're thinking about return, we could actually represent returns with a probability distribution. So for each possible return R, right? For each possible return R, right? We will assign R to this return R. Well, this sounds not intuitive at all, right? Let me give you an example. Let's say a stock, let's say Facebook, right? Facebook stock has two possible returns. So let's say it could generate 10% return for the next year, or it could generate minus 20% return for the next year. And for each possible returns, I will assign a probability, right? So let's say I assign 40%, right? And now it basically says for the next year, there is 40% probability the Facebook stock will generate a return of 10%, right? Now, what about this? What kind of number you will get here? Well, you guessed it. Here, you should write down 60%. The reason is because the sum of probability should be equal to 1, right? So it basically says 40% probability, the return is 10%, then it has to be the case that for 60% probability, the return is minus 20%. Okay, great. Okay, now let's talk about the formal definition. So now we want to talk about first the formal definition of expected return. So expected return is really the expectation in statistics, right? So generally, if you recall in your statistics class, given a probability distribution, you could calculate its expectation, right? So now in this corporate finance 2 class, giving you a probability distribution on return, then you could calculate expected return, right? More specifically, expected return is a weighted average of the possible return, where the weights correspond to the probabilities. So you could see the definition here. So basically, this is the symbol for expectation, right? This E means expectation. And according to this definition, it's the weighted average of possible returns. So you can see that this is the possible return, and it's weighted average because here probability serves as the weight. And then if you sum up, right, this sigma sign means sum up, right? If you sum up these numbers, now you will get expected return. A second related definition is variance and standard deviation. So given this distribution, you could also calculate variance. Variance is the expected squared deviation from the mean. And you can see we have a large or long formula here. Well, don't panic. It's actually quite simple. So first you can see that we wanted to look for the deviation. What is a deviation? Right? This is the deviation from the mean, right? Because this is mean, this guy is mean. And use the return minus mean, you will get the deviation from the mean. And then the definition also says we want to use this squared deviation. So that's why you get this square here. And again, we will use the probability as a weight. And again, just like calculating return, we will use this summation sign, right? This big omega. Now, based on the definition of variance, it's pretty simple to talk about standard deviation because standard deviation is just the square root of variance, right? And in finance, both variance and standard deviation, they're measures of the risk. Which means if variance is larger or if standard deviation is larger, then this probability distribution is riskier. In the context of return probability distribution, it basically says, let's say, if the standard deviation or variance of the return of Google stock is larger, then it means Google stock's risk is higher. In finance, a very important name is volatility. Well, it's just a fancy name for standard deviation. So just remember, standard deviation is volatility. Volatility is standard deviation. So now let's see, we have an example here. Let's say we have a stock. Its name is Progressive Waste Solutions, and the current stock price is $100. In the future, the stock could have three possible values. So you can see here it's $140, $110, and $80. So based on this, you can see, given these two columns, right? Given these columns, you should be able to calculate possible returns. For example, the first one is 40%. Well, how do you get this number? It's easy, right? It's just 140 minus 100 divided by 100. This gives you 40%. So by the same method, you could calculate the 10% and the minus 20%. So let's assume each of these returns has a probability of 25%, 40%, and 25%. So basically you can see that the last two columns, right? The last two columns give you the distribution of the returns. And given this probability distribution, you should be able to calculate mean and standard deviation. Okay, what is this? Okay, this is a visualization, right? This is a picture which visualize how this probability distribution should look like. You can see here for this horizontal axis, you get returns. And for this vertical axis, you get the probability. And if you look at the table here, it says for the return of 40%, the probability is 25%. So you can see that you're looking at this column here. It says for a return of 40%, the probability is 25%. We could also look at this second row, right? For this possible return of 10%, the probability is 50%. So again, 10% return, right? 40% probability. Now, as I said, we could calculate expected return, variance, and standard deviation. So if we go back to the formula, right? Let's see what is the formula here. So let's start with expected return. To calculate expected return, you will multiply probability with each return, and then you will sum these numbers. This gives you expected return. So now let's look at this. Let's look at this table, right? Okay, let me move this one. So now let's say I want to calculate expected return, right? So let's say expected return. Now, first, I will look at the possible returns, right? So I get 40%. Okay, let me use 0.4, right? For this 40% return, I have a probability of 25%. Now, plus the second case, 10% possible return times its probability, which is 0.5, and plus minus 20% return times its probability, which is 25. So if you have your calculator, then it's easy to find out what is the answer here. So the answer is 10%. Right? So this tells us the expected return is 10%. Now let's think about variance. Right? Now let's say we want to calculate variance of the return. Now let's go back to the formula and think about how could we calculate the variance here. So you can see that variance is the expected squared deviation from the mean, right? So basically you will first get the mean and then you will calculate the deviation. And then you will calculate the squared deviation and then times the squared deviation with probability. And then you sum up all these numbers. This gives you variance. Now let's do the calculating according to this formula. So first, let's say you want to start from squared deviation, right? So here, the first number is 0.4, which is the 40% return, minus the expected return, which is 0.1. Now, this is the squared deviation. And now you have to time this squared deviation with probability, which is 0.25. Now, do the same thing for other returns. Probability times return minus expected return plus, for the third row, the probability is 0.5, sorry, the probability is 0.25, so minus, oops, and the return is minus 0.2, so minus the expected return of 10% squared, right? Again, let me repeat. You can see that for every term, you're first calculating return minus expected return. Then you get this squared value. And then you time this value with probability. And then you sum up all these values. This gives you the variance, which is 0.045. So it's 0.045. Now let's calculate standard deviation. Well, this is simple because standard deviation is really the square root of variance. So it's the square root of 0.045. This gives us 21.2%, right? So it's just a very basic calculation. What you need to do is to understand the formulas of calculating expected return and variance. And then you want to, of course, plug in numbers in a correct way. Okay, now let's look at the another example. So let's say the BlackBerry stock is equally likely to have a 45% return or a minus 25 return. What is its expected return and what is the volatility? Well, let's first start with expected return, right? Oh, I guess it's better if we start from the probability distribution, right? So we have two cases, right? So the return has two values, 45% or minus 25%. Now, what are the probabilities? Well, the problem says these two values are equally likely, right? Equally likely. It basically means 50% versus 50%, right? So these are returns, these are probabilities. Now we want to calculate expected return. So expected return equals return times its probability plus another return. Plus another return times probability, right? So this gives us, I believe it's 10%. Right? It's 10% or 0.1. Now let's calculate volatility. Obviously, to calculate volatility, the first step is to calculate variance. So to calculate variance, we will use, first let's say we start with squared deviation, right? So return minus expected return, squared deviation, right? Again, return minus expectation, right? And we will time these squared deviations with probability. So it's 0.5. And then we will sum up these two values. This gives us 0.1225, right? So it's 0.1225. And next, we will want to work out the volatility. So it's just the square root of variance. Let's see what do we have here. It's 35%, right? So if you compare this example with the previous example, you can see that we have the same volatility, right? Oh, no, sorry. We have the same expected return, but we have different volatilities. So if you look at this example, we have a expected return of 10% and we have a volatility of 21%. And now if you look at the example, that is the BlackBerry stock, it has the same expected return, 10%, but its volatility is significantly higher at 35%. So we could also visualize these two different distributions. So here the BB, right? The BB refers to the second example, that is 10% return and 35% volatility. The BIN, I think it's this Progressive Waste Solutions firm. So it has 10% return and 21.2% volatility. Right? If you compare these two different distributions, you can see that BlackBerry, right? The value of BlackBerry, they're concentrated on two sides. This basically tells you that BlackBerry's returns are more spread out. That's why BlackBerry has higher volatility. And now you have this alternative example. It basically, alternative example changes some numbers compared with the actual example. It's good practice if you have time, so you can use these numbers and answer these questions yourself. Okay, now let's talk about historical returns of stocks and bonds. So remember, we just calculated expected returns and volatility. A very important basis of calculating expected returns is you're given a probability distribution, right? Again, remember the process. First, you're given this probability distribution, and based on this probability distribution, you could calculate expected return and volatility. This is good exercise. But if you think about the reality, it's not the case, right? So let's say if I want to ask you, hey, what is the expected return of Google? Obviously, I cannot give you a probability distribution, right? Because there is no such thing, right? Because all you have is some historical data, right? All you have is some historical returns of Google stock. So what actually happens in reality is you will have some historical data, and then based on this historical data, you will be asked to calculate average returns and volatility. So now we are dealing a more realistic problem. That is, again, given historical returns, how should we calculate average return and variance and volatility, right? So let's first start with realized return, right? So realized return is the return that actually occurred over a particular time period. So you can see here, if you have time t and time t plus 1, right? So the timeline looks like this. This is time t. This is time t plus 1. And at time t, the stock price is PT. And at time t plus 1, the stock price is PT plus 1. And you will get some dividend. Right? Let's say at the same time, at time t plus 1, you will also receive some dividend. Now, what is the return? Well, the return is basically dividend t plus 1 plus price t plus 1 divided by PT minus 1, right? And then you can see that you could actually separate this formula into two components. And this first component, that is dividend divided by price, is called dividend yield. And then the second component, it is called capital gain rate. It's called capital gain because you can see that in the beginning you got PT, and in the end you have PT plus 1. So if the stock price increases, there is a certain capital gain, right? So basically PT plus 1 minus PT gives you capital gain. And if you divide this capital gain by the initial price, this gives you capital gain rate. Okay, now let's think about a more complicated case. Let's say, generally, if you buy stock, you could hold it for many years. So generally, you will hold the stock beyond the date of the first dividend. Now, in this case, you will have multiple dividend, right? So now one question is, how do you calculate your returns if you have received multiple dividends? So here, let's assume every time if you receive your dividend, you will just use that dividend to buy the same stock. That is, you will reinvest your dividend, right? Now, let's see this example. Let's say if a stock pays you dividend at the end of each quarter, and the realized returns are RQ1, RQ2, RQ3, and RQ4, right? Now you want to calculate its annualized return. In this case, you can see that 1 plus the annualized return equals 1 plus the first quarter return times 1 plus the second quarter return, 1 plus the third quarter return, 1 plus the fourth quarter return. So the idea is really simple. You can see that the right-hand side is really about compound return, right? Essentially, it says, if I have $1 in the beginning of the year, then at the end of the first quarter, I will have 1 plus RQ1. And then I will invest this 1 plus RQ1 into the second quarter. So at the end of the second quarter, I will have this amount. And you will continue to do so, right? You will have this amount at the end of the third quarter, and then you will have this amount at the end of the fourth quarter, right? So this gives you the compound return for this whole year. And then obviously, if you use this formula, you could calculate this guy here, right? That is your annualized return. Okay, now let's see an example and learn how to calculate realized annual return here. So let's say we have the following table, right? We have the table for Barrick Gold. Okay, let's look at this Barrick Gold, right? So you can see that this table, right, gives us stock price and dividend for this firm. And our task here is to calculate the realized annual returns in 2004 and in 2008. So let's say I wanted to calculate 2004, and our task here is to calculate the annual return. Now, just think about this. So on the left-hand side, you can see that you will purchase the stock at the price of $29.31, right? And the next date, which is June 15th, 2004, the stock price will become this, 26.39, and you will receive this dividend. Right? So you can see that you will first calculate the return during this period, right? To be more specific, the first return is calculated as 26.39 plus 0.1506 minus 29.31 divided by 29.31. So this gives you, I don't know what is the number. I think it's 0 0.955. And now let's compare. This. Oops, sorry. So now let's compare this date and this date. In this case, you will again calculate the return. So the return is 28.2 plus 0.1345, which is the dividend, minus the initial price, and divided by the initial price. So this gives you 1.0972. And then we will look at these two dates here. So you can see that on the last date you don't have a dividend, so you will just directly use the price, the $29 minus 28.82 divided by 28.82. This gives you 1.0062. Now remember that we said if you want to calculate this annualized return, you have to multiply all these numbers. That is, you have to multiply this, this, and this, right? So you can see that this line gives you the annualized return. That is, you multiply these three numbers minus 1. This gives you the annualized return for 2004. Of course, the problem also asks you to calculate the return for 2008. It's essentially quite similar, right? The method is the same. So I recommend you to take some time and do the calculation yourself to actually solve the annual return in 2008. Okay, now by understanding how to calculate the average returns, right? Sorry, by understanding how to calculate the realized returns, we could actually look at the historical data, and then we could calculate the realized returns for this composite index, this guy here. We could also calculate realized annual return for this Barrick Gold, or annualized return, annualized return for this 3-month T-bill return. What you can see here is you can see that for this Canadian stock market, right? Remember, TSX Composite Index basically represents Canadian stock market. You can see that there is this huge variation in annual return, right? You can see that in a bad year, you get minus 32%, and in a good year, you get 34%, right? It's the same for Barrick Gold. The lowest value is 22%, right? And in the year with the best performance, you get almost 30%. And then for T-bill, you can see that the variation is much smaller. The lowest number is, I believe this guy here, right? 0.35%. And the highest number is here, 5.56%. And then after getting these realized returns, our task is to calculate these guys, right? So again, given realized returns, we can calculate average, variance, and standard deviation. Now, the first one we want to make sure to understand is the average annual return. And this is simple, right? Everybody knows how to calculate average. So basically, you will sum up these numbers together, and then you will divide the sum by, in the case of calculating average returns, you will divide the sum by a number of years, right? So, for example, if you look at this table, right? If you Look at this table. So here what we can do is given these realized returns, that is given these realized returns, we can calculate this guy, the average return. Now, how do you calculate the average return? Well, as I said, it's easy, right? You will sum up all these numbers, right, from 1998 to 2012, right? Sum up all these numbers, then divide this number by the number of years. How many years do we have here? I think we have 15 years, right? So the average, you can see that the average is essentially the sum divided by this guy, 15 years, right? So the average is about 8.18%. Now, after getting average, let's talk about variance. Remember that we have learned about how to calculate variance if you're given a probability distribution. Here, we are having this realized returns, and still, we can also calculate variance. However, you have to be careful. The formula here we're using is different, right? You can see that to calculate variance with realized returns, you would want to use return minus the average return, right? So again, you can see that this part is squared deviation, right? And then you will sum up, right? You will sum up the squared deviation divided by number of years minus 1. It's important to be careful that you want to use t minus 1. You're not using t here. As to why, if you have learned your statistics class carefully, then you would be told by your statistics professor that this is a unbiased estimator of the actual variance. I don't want to go to some depth into why do you want to use t minus 1 here, because we're not having a statistics class. But I want you to remember you should use t minus 1. And then after getting variance, to calculate standard deviation is an easy task, because again, standard deviation is the square root of the variance. Now let's see this example here. It says, using the data from table 10.2, what is the variance and volatility of the SPTSX composite index return for the year 1998 to 2012? Okay, now let's look at this table here. So you can see that you basically have 15 years, right? And you have all these realized returns. And our task is to calculate volatility. Using this formula, you can see that you wanted to calculate the first squared deviation, and then you will sum up these numbers divided by 15 minus 1. So let's see how the answer works. Well, it's exactly, it is using the exact formula we have just learned about, right? So you can see that for the first RT, right, for this guy, you want to use this realized return. The first realized return is this number. Let's see whether this number is correct. You want to use this number, right? So it's minus 1.2%. Sorry, it's minus 1.5%. So we're having this number here. Then minus average return. We have calculated average return is this guy here, right? It's 8.18%. So you want to minus average return here, right? And then after calculating this squared deviation, you want to sum up them together, right? Sum up these values. And then you will divide the sum by number of years, that is 15 years minus 1. So this gives you 0.0351. And by definition, to calculate volatility, you will use the squared root, right? So this gives you 18.74%. Now, after understanding how to calculate average return and volatility and variance, given historical data, you guys should be able to calculate the average annual returns and the volatility, right? So you can see here, this table gives you average annual return and the return volatility for these 3 different investments. So you can see that for 1950, from 1950 to 2011, the annual return for Canadian T-bills is 5.56%. For long-term bond, it's 7.6%. And for composite index, it's 11.37%. So you can see that if you go from short-term bond, remember this is short-term bond, right? So this is short-term bond. And this is long-term bond. And this is Canadian stocks, right? So if you go from short-term bond to long-term bond to Canada stocks, then your return will go higher and higher. And now, if you look at risk, if you look at these volatilities, you can see that as the return becomes higher and higher, risk also becomes higher and higher, right? So again, we have the sort of the same result we have got in the beginning of this class. That is, as your return goes up, the risk will also goes up. So there is this positive correlation between return and risk. Again, the reason is because as an investor, if you want me to bear higher risk, I will demand higher return. That's why you could observe this positive relationship here. Okay, next, let's think about portfolio, right? Let's measure a portfolio's return and risk. Remember that until now, we were always talking about a single stock. So we were always talking about a single bond, a single index. So we were always talking about a single stock's return and risk. Now we want to think about portfolio. First, what is a portfolio? Well, a portfolio is really a collection of assets. Let's say I have $10. If I put $5 into Facebook stock and I put the other $5 into Apple stock, then I will have a portfolio of 2 stocks, right? This is a 2-stock portfolio of Apple and Facebook. Of course, you could have a portfolio with many stocks. Let's say if you want to invest in SP 500, in this case, your portfolio has 500 stocks. To understand or to measure a portfolio's return and risk, we need to first define portfolio weight. Portfolio weight is essentially the fraction of the total investment in the portfolio held in each individual investment in the portfolio. This is a very simple definition. So it basically says if you want to calculate portfolio weight for investment I, then what you need to do is you want to divide value of investment I by the total value of portfolio. You will see an example very quickly, which will help you to understand how to do this calculation here. A basic mathematical fact is if you sum up all portfolio weights for the assets in your portfolio, then the answer is 1. That is, the portfolio weights must add up to 1 or 100%. Now let's look at an example here. So let's say you have a portfolio of 200 shares of Disney stock and Coca-Cola stock. And the share price for Disney is $30 and the share price for Coca-Cola is $40. Now you want to calculate the portfolio weight of Disney and the portfolio weight of Coca-Cola. So let's say we want to calculate portfolio weight of Disney. Now what you need to do is you want to calculate value of Disney stock divided by total value, right? Total value of your portfolio. What is the total value? Well, you have 200 shares of Disney stock, which is priced at $30. And you have 100 shares of Coca-Cola stock, which is priced at $40. So if you sum up these, the values of these two stocks, you will have the total value of your portfolio. And now, what is the value? What is the value of Disney? Well, it is 200 times 30, right? So this gives 40%. Now, what is the portfolio weight of Coca-Cola? You can see that the lecture note gives you this more complicated version of calculation, right? You wanted to calculate the total value of Coca-Cola stock, and then you divide this number with the total value of your portfolio. But you have an easier way to figure out, because we know that if you sum up the portfolio weights, then the answer has to be 1, right? Which means the portfolio weight of Coca-Cola has to be 1 minus XD, which is 1 minus 40%, which is 40%. Okay, why do we want to understand portfolio weight? Well, because we want to calculate the realized return of a portfolio. Now, how do you calculate the realized return of a portfolio? Well, here we have the formula here. So basically, the realized return of the portfolio RP is the weighted average of the return on the investments in the portfolio. So you can see that if you look at this part, you can see that RI is the return for the investment I, right? XI is portfolio weight. So basically you will time portfolio weight with the return, and then you will sum up all these values, right? You will sum up. And this gives you the realized return of the portfolio. Again, you guys will see a example which gives you this idea how to actually calculate the realized return. Okay, now let's look at this example here. It says, suppose you buy 200 shares of the Disney stock at $30 and 100 shares of the Coca-Cola stock at $40. If Disney's share price goes up to 36 and Coca-Cola's price falls to 38, what is the new value of the portfolio and what return did it earn? Show that this equation, right? Should this equation actually holds, right? And the final question is, after the price change, what are the new portfolio weights? Okay, now let's look at the first question. What is the value of the portfolio, right? Okay, let's see. The value of the, let me write down Q1 here, right? The first question is about the new value the new value of the portfolio? Well, it's really easy, right? You have 200 shares, and the new price of Disney stock is 36, and you have 100 shares of Coca-Cola, and the price is 38. So this gives you 1100, right? And now the second question is, what return did it earn? Right, Q2, what return did it earn? Well, the final value of your portfolio is 11,000, and the initial value is 10,000. So the return is just 10%. The third question says, show that the equation actually holds. That is, this equation actually holds. So Q3, how do you show this equation holds? Right, how do you show this? Well, if you want to show this equation actually holds, you want to show that the left hand side equals the right hand side. Right? What is the left hand side? What is RP? Yes, you're right. It's 10%. Now, what is the right hand side? The right hand side is XD, that is the portfolio weight of Disneyland, times the return of Disneyland, plus the portfolio weight of Coca-Cola and the return of Coca-Cola. So what is the portfolio weight of Disneyland? Well, we have done this before, right? Disneyland has a portfolio weight of 0.6, so it's 0.6 times the return of Disneyland. Well, this is easy. In the beginning, Disneyland has a price of 30, and then it becomes 36. And the portfolio weight of Coca-Cola is 0.4 times so what's the initial price here? Oh, it's 40, right? 40. So it's 38 minus 40. I guess you could verify that. You should be able to verify that this gives you 10%, right? So basically this tells us, well, we know that 10% is our P. This tells us this formula actually holds, right? Now, the last question. What are the new portfolio weights, right? Q4, right? New weights. Again, we will just use the value of the investment divided by total value of the portfolio. So let's say we call the new portfolio weight for Disneyland as XD prime. Then the portfolio value is 11,000, and the value of Disneyland, the value of Disney stock is 200 shares times 36. So this gives you 65 65.45%. And then Coca-Cola is this, right? So it's 30 something. So 34.55. Okay, that's for today's class.